During our last economic update, markets were falling rapidly. There was panic in the bond market and economists were talking about a strong probability of recession in 2016. Despite some bumps in the road along the way, the U.S. economy has been in expansion since July 2009. While many economists have predicted a recession several times along the way, SEM's leading economic indicators have not flinched. Since that last update in December, we've seen those indicators strengthen a bit, further reducing the chance of a recession in the next 12 months. My name is Jeff Hybiak, and I'm the Portfolio Manager for Strategic Equity Management. In our quarterly economic update, we're going to talk about some of the things that may influence the economy, both over the short and the long term. This chart of GDP growth really tells the whole story. Despite some unprecedented stimulus measures, growth has remained below the long-term average throughout the recovery. A bigger concern is the declining trend overall and what that means for long-term economic models, something that is far more important than the short-term direction of the economy. However, over the shorter term, our leading economic indicators continue to point to a positive but below average growth rate. We're still talking about somewhere around the 12-month growth rate of 2.2 to 2.5%. The most recent report on housing was a good one. As our longtime followers know, housing starts as one of my favorite leading or sometimes coincident indicators. It depends on how you look at it. It's kind of the chicken or the egg type of thing. So if you want to say that it's a leading indicator, then you would believe that housing starts really create a bunch of economic activity, and then that boosts GDP growth rate. There's a lot of sound arguments that go along with that. But also, you could just look at it and saying, well, people buy houses when they believe the economy is strong. So that makes it more of a coincident indicator. Either way, we can see that generally speaking, we see them tracking up and down. Most recently, the economic growth was strong as far as housing goes, and we expect that to follow suit with the economy. One thing that could throw a wrench in the positive growth is further tightening by the Federal Reserve. That could hit housing as well as consumer spending at a time where the recovery is still really fragile. During their last meeting, the Fed discounted what they called volatile inflation measures recently, but reviewing some of those volatile components, we can see on this chart that inflation is picking up rapidly. This excludes any of those things the Fed was mentioning, food, energy, and the like. So that could cause the Fed to change course as far as their inflation outlook goes relatively quickly. We've only had 3 rate hike cycles going all the way back to the early 1990s. In the last 2 cycles, the Fed did not hurt the current growth rate, but once they stopped easing, they kind of went too far, threw the economy into a recession, and then once again they were left scrambling, and so it's something we have to be very, very careful about. If the Fed chooses to hike again too soon, this could completely change our economic outlook. So, as I like to say, stay tuned on that account. Shifting our focus to the longer term, we can see some of the changes in the dynamics of our economy. If you look at each of these bars, we have the long-term growth rate going back to 1947, the 30-year growth rate, the 10-year growth rate, and the 1-year growth rate. And each colored stack is the contribution to GDP growth rate. And if you can see there, the biggest change has come in consumer spending. And that's really the biggest contributor to economic growth, so it's something that we have to watch rather closely. Most recently, we just saw this morning, as I am taping this on March 28th, the government gave a basically in line with expectations report on consumer spending for February, but they revised down January's number. So that's something we're going to have to watch closely. One reason we could be seeing a drop in overall consumer spending is just that distribution of wealth. During each expansion, as this chart shows, corporations have kept an increasing amount of the profits. That divide between corporate profits and income growth has gotten larger and larger. This also can explain the popularity of candidates like Donald Trump and Bernie Sanders that have offered differing viewpoints than what we've seen perpetuated over the last 16 years. Even worse than the divide between profits and income is the exponential growth we've seen in the overall level of debt. Now, if used to invest in long-term projects that create future growth, Debt can be really beneficial to the overall economy. But instead, what we've seen, both government and corporations have used the debt to just kind of put short-term band-aids over some current problems. And this is one of the reasons that I believe that long-term growth going forward is going to be well below that long-term average that we talked about. So what's this have to do with investing? It's really quite simple. Over the very long term, the only driver of stock prices is earnings growth. The only driver of earnings is the economy. It's just simply how capitalistic economies work. And as I like to say, at least for another few months, depending on how the election goes, we still live in a capitalistic society. We see good companies do really well, bad companies don't do so well. Overall, that's the economy, that's the earnings growth rate, that's the market. That's why we have to pay attention to this. So if you look at the debt rate and that headwind we have there, you look at the valuation levels of the market, which are highest levels we've seen except when we've been in past market bubbles. It really tells you to be cautious, be careful out there. The economy might be doing okay for now, but there's a lot of speed bumps along the way that could cause things to be hurt. Now, in between our quarterly updates, our website is a great resource for up-to-the-minute details on what's happening. You'll always see us post these economic updates there if you don't follow me on YouTube or social media. But we do weekly podcasts where we talk about what's happening in the market. My blog, I put a link there. You go to resources, click on web links and scroll down to blogs. I talk about the markets daily, but what's really critical with everything on our website, everything we do at Strategic Equity, is it's about the data, not my opinion, not Rick Gage's opinion. It's the data from the economy all the way down. We want to just look at the data, give you some facts, and let you make your own decisions. So, as always, I thank you for joining us. If there is something that requires an update between now and the end of the coming quarter, we will be here. We'll give you an update. But until then, just urge you, be cautious, look at the data. And as always, check out stratequity.com for all the latest updates.